Greeting everyone. Thank you for joining us on this virtual real estate panel. And thank you IAJF for sponsoring this great event. For those of you who don't know me, my name is Hersel Torkian, and I will be your moderator tonight. Just to give you a little background of myself, I'm honored to sit on the board of IAJF and be a part of such a great foundation as we continue to help out communities in need through this pandemic. I also work in both real estate and retail industries, so I'm very excited to be participant of tonight's discussion. So the topic of tonight's event, and I'm sure is on everybody's mind, is the future of New York, its real estate, and other aspects such as new laws and regulations that come into effect due to COVID-19, and the resulting of Governor's Order of New York on pause. On behalf of our board and audience tonight, let's extend a warm welcome to our panelists. Thank you, gentlemen. Great to see you all, and I'm glad that you are able to join us. IAJF and I are looking forward and to have your expert opinion on the matter. Tonight is about learning your views and anticipation of how your industry sectors will navigate during and after the current crisis in New York. First, let me introduce our panels. Our first panelist is Mr. Bob Knakal. Bob serves as chairman of the New York Investment Sales with John Lang LaSalle Capital Market. He started his career in 1984 at C.B. Richard Ellis, where he met Paul Massey. Together, they co-founded Massey Knakal Realty, where Bob served as a chairman. From 1988 to 2014, Massey Knakal closed over 6,000 transactions in excess of $23 billion. Our next panelist is Mr. Myron Altshuler. Myron is one of the best founding partners of the law firm Bora Goldstein Altshuler Nines and Goydel PC. For over 45 years, his law firm represented many landlords and tenants in residential and commercial properties. Myron and his firm are pioneers in the prosecution of summary non-payment and holdover proceedings and have substantial practices in commercial litigation in New York. Our last and but not least panelist is Mr. Ralph Herska. Ralph is a chairman and CEO of Meridian Capital Group. He's the guiding force behind the community's evolution from a small Brooklyn-based commercial mortgage brokerage firm to a national leader in real estate capital market. Ralph demonstrated an exceptional ability to foster multi-generational relationships with real estate owners and investors and forge critical alliances with lenders to achieve success across the asset spectrum. Welcome again to you all, and without further ado, I'm going to turn the first question for this event. As you know, real estate has been hit hard in the last 12 months, from rent reform laws to the COVID-19 pandemic. I want to ask each of you what your expert opinions are on the future. We can start with you, Bob. Generally, where do you see the market currently and in the near future?
Well, Herschel, firstly, it's a pleasure to be here tonight with you and with Ralph and Myron. Always nice to see you guys. I wish we could see each other in person, but this seems to be the way of the world these days, these video conferences. You know, I think from an investment sales perspective, it's a very interesting time. I believe that the bull market that we were in really ended in the beginning of the fourth quarter of 2015. We saw a disruption in the land market and in the hotel market at that time. And really since then, the volume of sales has been sliding since. And I really thought that after what was the longest correction in New York City that we've seen in the last 40 years, we thought based on the activity in the fourth quarter of last year that we might be coming out of this correction. But then of course, the first quarter numbers were surprisingly disappointing. And if you take into consideration that in the first quarter of this year, the volume of sales was down about 35%, from where it was last year. And COVID really had very, very little impact on those numbers. That was surprising in and of itself. And then, of course, sometime in March 10th, 12th, 15th, something around there, the real impact of COVID hit us, and that has thrown a curveball into the market as well. And one of the interesting things, if you put this current time period into perspective and this current correction in investment sales, which now we're 57 months into, the diminution in value from 2016 through earlier this year was really not all that significant. Maybe about on average about 10 or 11%, which compares very favorably to the Great Recession from 2007 to 2010, when value dropped 38% on average, and the S&L crisis, which we all remember from the early 90s, when average values dropped 58%. So the diminution in value wasn't that significant, but now based on COVID, we need to see what the impact on underlying fundamentals is going to be. And it's very likely that that reduction in value that we've seen so far in this correction is going to grow quite a bit, and that will depend on different product types. But generally, it's a market in which now we are looking for data points desperately to try to figure out what values are. I've been doing this 36 years, and I think it's the first time in my career where it's really so challenging to figure out what something is worth, because there haven't been many post-COVID contracts signed that have closed. So we're looking for data points. We're looking for guidance from the marketplace. And I think we're really in a process of price discovery now to try to determine where values are relative to where they were pre-COVID, and to get a sense of where they might be headed. But it's a very unique and very challenging time for the marketplace right now.
Okay, thank you so much. Now, Myron, a two-part question. How do you see the climate of regulations and law in New York as it pertains to real estate? Where do you see the future of rent regulations?
Well, first of all, let me also thank you, Herschel.
Thank you, thanks.
For inviting me to the panel discussion. I'm very pleased to be here, and I hope I can impart some information which is valuable.
I'm sure you are. I'm sure you are.
To answer the first part of the question, I have to go back to the Housing Stability and Tenant Protection Act of June 2019. With that act, the climate decidedly changed in tenants' favor. During that time frame, my law firm gave 2 and 3 hour lectures on all of the different portions of that act. Obviously, tonight, I just want to highlight a few of the things that are part of that legislation that really changed the whole equilibrium from landlord-oriented to tenant-oriented circumstances. For example, luxury decontrol and vacancy decontrol were repealed under that act. The benefits for major capital improvements and individual apartment improvements were so severely restricted that landlords did not have any incentive to improve the building or improve the individual apartments. Co-op and condo conversions, in terms of the eviction, co-op and condo conversions, that was repealed completely. And for non-eviction plans, instead of subscribers having to be 15%, the new subscribers had to be 51% to allow the conversion. Interestingly also, there are no sunset provisions for the rent control and rent stabilization laws anymore. They are now permanent. Previously, every 4 or 8 years, the legislature had to make a determination that there was a housing emergency in order to extend the regulations. This no longer is necessary. Just currently, the Rent Guideline Board found that for rent stabilized leases, for 1-year renewals, they will only provide a 0% increase. For 2-year leases, only 1% increase.
Right.
This has never happened before.
Right.
Lastly, and significantly, summary proceedings are no longer summary, if they ever were summary. With respect to the future, I can only hope that the equilibrium changes from this extreme tenant-oriented circumstance to a more balanced approach. And I hope that the courts themselves will be interpreting the Housing Stability and Tenant Protection Act in certain ways to make it somewhat more favorable to landlords. Very quickly, one instance, the act provides that a 5-day letter has to go out to each residential and commercial tenant, but it's not clear that it really intended to relate to commercial tenants. One court has now decided it doesn't relate to commercial tenants. But until there's an appeal court that says it doesn't apply, we're stuck with it.
Okay, thank you so much. One more thing, for those viewers that they don't know about sunset law, can you explain what does that mean, sunset law?
Well, basically what I meant was that there was a point in time when the rent control laws had expired, and that in order to be renewed, the legislature had to make a factual determination that there was a crisis in the housing market in order to extend the regulations. With this last act, that is no longer necessary.
Okay, thank you so much. Ralph, I have a question from you. In general, how do you think these last few months have affected lending at the present time, and what lasting effect will this have on the future of lending?
First of all, Herschel, I want to thank you for.
Thank you. Thank you
somehow,
so much.
I guess when you're number one and everything you do, you end up being number 3 in the panel. So I forgive you for it. But anyway, it's good to see Bob. It's good to see Myron. You know, I have a quick question. We're here to talk about New York City real estate. So I see, Herschel, where are you? Where's everyone now? Are they in their home?
I'm in Long Island right now.
So you left New York. You left New York City, Bob.
No, I've been always in Long Island.
I'm in East Haddam, Connecticut.
So that JLL sign is really hiding a beautiful view, right?
Absolutely.
All right. So let's talk about the question that I was asked. I just waited so long to get to speak that I had to just break the ice a little bit. But really, it's great to see everyone, and I wish we could be in person. And I got to tell you, you know, in phase 2, I've been in the office this week and following all the regulations. And the city is starting to feel a little bit of a vibe again. So I just want to talk a little bit about that. But the question was, how do I think the markets have reacted to COVID-19? I think Bob said something that's really interesting. And one of the things that's unique, I'm going to talk from a financing perspective, because while we heard that there's been a decline in values and sales over the last couple of years, what's actually happened in the finance world over the last couple of years, it's been very, very robust. There were many lenders coming into the market, many funds, many insurance companies. And I think that is something that COVID-19 actually brought to a pretty quick halt. And I want to talk a little bit about that. And again, you know, what I said before when we were talking is, in this market, the hardest thing to do is to talk in general, because there are no generalities in this market. Everything is very, very specific. You know, you can ask me what a bank is doing, what a lender is doing, or what type of asset class. Retail, is it apartments? Is it office? Even in retail, credit tenants. So I think what's happening in the market is the lenders are being very cautious. They've all gotten very, very smart and realized that this thing can come and last for a while, and they're being very cautious now they're underwriting loans. The good news is that we've seen the last 3 months, on the multifamily side, we've seen some very strong collections. Even in New York City, we're seeing above 90%. In the boroughs, we're seeing in the high 80s. So I think if you really look at numbers and you understand underwriting, if someone collects 70 to 75% of their rent, they can pay their mortgage payment traditionally. So I think what's interesting is on the multifamily side, continuing to see lenders, and they're taking reserves, they're really focused on collections, what they are, and they're continuing to. The retail is a whole different market.
Right.
And I mentioned that. And then office, it all depends who the office tenants are, where they're located. If they're small tenants, are they in the jewelry district, or are they on the main avenue? And I think even office, we're actually able to get some office deals done in this market. So I think all in all, the market has come to some type of slowdown. I wouldn't call it a screeching halt. It was a screeching halt when COVID hit in March, but I think it's recovering slowly, and lenders are being, very careful how they're lending, but they're definitely continuing to make loans.
Right. Okay. Is there a different? Is it agency or domestic or foreign banks? I mean.
So I think it's interesting. First of all, on the multifamily side, you have the local banks that have been in the business for many years, that understand the market and have been lending to the families and understand their clients, so they're continuing to lend. Then you do have, of course, Fannie Mae and Freddie Mac. That is, their mission is to always have liquidity in the marketplace, and they have done a phenomenal job in understanding underwriting, understanding reserves, continuing to lend, through this situation, but cautious and making sure that they're doing it correctly. And then you even have some life companies that are smart and they understand where the leverage point is. And a 50% loan to value pre-COVID or post-COVID or during COVID is still a 50% loan to value.
Okay.
So I think it's all over. I mean, we're seeing some foreign banks reach out to us and saying New York City is the capital of the world. Us being in New York City, we see all the negative things about it. But sometimes from the outside, you see, they see what New York is, and they like to get a part of it. So I think it's really an array of all different type of lenders, and that's what's interesting.
Thank you so much. Okay, the laws and regulations surrounding real estate have already been impacted. Now I want to ask you more specifically in your areas of expertise on how you see those changes shaping in the future. I'll start with you, Myron. Is the New York City legislation suspending personal guarantee and good guy guarantee between March 7 through September 30 enforceable? Based upon changes to commercial law, do you foresee landlords requiring more protection language in their leases? What do you see tenants have gained from their experience during this COVID period, and how will that affect their future conduct?
Well, first of all, in my opinion, the suspension of personal guarantees is a taking of property without due process. And I think it violates our New York State Constitution and the federal Constitution. If I may, by way of background, courts generally presume that in a commercial leasing situation, the parties have equal bargaining power. They generally will review a commercial lease, and if it is not ambiguous or unclear, they'll strictly enforce it without any deviation. There are times when a court may find that a provision is what they say unconscionable. For example, if a lease were to provide that upon a tenant's vacatur, after they were supposed to vacate and where they held over in the commercial space, if the provision said, for example, that the tenant now has to pay 4 times the rent that was reserved in the lease, that has been found unconscionable. The courts basically say it is void as against public policy. But in my opinion, again, suspending personal guarantees for any period of time is just too extreme. The landlord would not have executed the lease with the tenant, but for the financial stability of the guarantor. Turning to the other part of your question.
Sorry, it's a long question. I apologize.
That's okay. That's okay. I do think that landlords are going to be asking for much more significant security deposits.
Right.
Additionally, I think with respect to the good guy guarantees, I think that landlords are not going to accept a surrender by the good guy guarantor for a period of 30 or 60 days. It's going to be extended to 90, 120, or maybe even more. On the flip side, I think tenants have experienced the unique situation that they don't need all of that office space in New York City towers, that by reason of their employees operating remotely and at home, they don't need that space. And I think this is going to impact on future leasing and renewals.
Right. Okay. Are the courts, by the way, open, or when will they be open to commence non-payment proceedings? What are the concerns landlords face with new commercial anti-harassment laws?
All right, I'll take the second part of that question first.
Okay.
And to answer that part, yesterday, the courts, the civil courts of New York City opened to handle non-essential landlord and tenant proceedings. But I must say that confusion abounds. As to the first part of the question, Stanley Kramer aptly titled one of his famous movies, "It's a Mad, 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 Mad World." And that's what we are living through right now. For example, while I can purchase index numbers in the civil court, the chief judge of the courts in a memorandum last Friday said that we can only do it by mail, not in person. Oh, and then we can use new technology and electronically obtain index numbers for new cases. The only problem is the judge was apologetic. That electronic system has not been created yet for the civil court and will not be available until the end of the summer. Critically also, the Department of Consumer Affairs regulates process servers. And logically, if you could start a case and buy an index number, isn't it logical that a process server should be able to take that file and document and serve it? Well, the Department of Consumer Affairs has not revoked its directive that process servers can only serve non-essential matters. And until they revoke that directive, attorneys, the clients, the process servers themselves could be subject to penalties through the violation of Department of Consumer Affairs regulations. Also, the Department of Investigation, which monitors city marshals, will not permit evictions until the earlier of August 20th of 2020. And I'm not holding my breath, but I think that will be pushed off into the future as well.
Right.
Additionally, there's a substantial backlog of cases in the civil court. There's going to be a huge amount of new cases coming in.
Right.
We can expect adjournments of 3 to 8 weeks. Also, if you want to talk about a bizarre situation, if a tenant failed to answer a non-payment proceeding before COVID-19, you would normally be able to get a default judgment. You would normally be able to obtain a warrant of eviction, but that has been stayed, and there is no date set when you can get a default judgment. So a tenant who fails to appear is in the wonderful position of
Right.
not subject to eviction.
Okay.
I'll just, one last thing which just came about recently within the last 10 days. Landlords now, before they start non-payment proceedings, must make an investigation as to whether his or her residential tenant has suffered because of COVID-19 or is collecting unemployment insurance. And
Right.
until you make that investigation, you cannot proceed to start your non-payment. I have to certify that the investigation was made.
Yeah, Herschel, you asked, Myron, if I could interrupt you for 1 second.
Sure. Go ahead, please.
You know, you asked about what the future holds, given the legislation that has gone on, the new policies that have been implemented. And I think as Myron very succinctly articulated what has changed in the multifamily space, the thing that I think is really overlooked is what is going to happen to the quality of the housing stock based on this new legislation. I mean, I vividly remember the 1977 World Series where, you know, the Yankees are playing the Dodgers and Reggie Jackson's hitting those 3 homers and the Goodyear blimp is panning out around the stadium and there are several buildings on fire. And there was no motivation for the private sector to invest in the housing stock at that time. That's when the IAI and the MCI was implemented, and that incentivized the private sector to invest hundreds of billions of dollars into the housing stock, such that, you know, in 1976, the dilapidation rate in the housing stock in New York was 14%, meaning 14% of the units were uninhabitable because of their condition. And today, based on this massive investment by the private sector in the housing stock, the dilapidation rate is 0.04%.
Wow.
And the problem is that now the marginalization of the IAI and the MCI program have basically created a disincentive for the private sector to invest in the housing stock. And these buildings, if something doesn't change, the conditions are going to deteriorate over time. And the politicians have some cover because buildings will not deteriorate overnight, but over time, certainly there is a disincentive for investment in the housing stock. And that's really the shame of the new legislation.
Okay, got it. Thank you. Myron, are you done?
Well, I think you asked also what today might constitute harassment of a commercial tenant.
Right.
And there is a bill that was passed in July of 2016 by the City Council, signed by the mayor. It's called the Non-Residential Tenant Harassment Act. And in that bill, harassment is defined as any act or omission by or on behalf of a landlord that is intended to cause a commercial tenant to vacate its premises or to cause it to surrender or waive any rights that it might have under its leasing documents.
Wow.
And there's a whole list of things that might constitute that. Just a few are, for example, implied threats that force will be used by a landlord, interruptions or discontinuance of services to a tenant, repeatedly commencing frivolous court proceedings, restricting ingress or egress, or unnecessary construction or repairs on or around the commercial space. So this is all new. This is all new to the commercial arena.
Thank you so much. I appreciate it. Bob, let me ask you a question. How do you see the pandemic affecting investment sales in New York? Do you believe New York City still is the safe haven it's always been for our real estate investors, domestics and international buyers? And where will most investors seeking value be steering their capital?
Well, that is a great question, Herschel. And I say I am such a fan of New York City. I think New York is the greatest city in the world, and it goes through ups and downs. But I think we'll always survive and always thrive. That being said, given what's happened with COVID, it has slowed down the pace of investment sales. Ralph mentioned earlier that the financing market is coming back a little bit and more activity. Fortunate for Ralph, when somebody has a mortgage maturing, they have to do something. So there's a built-in motivation to make a deal. But on the sales side, it really has created an impediment simply because we can't show properties today. So for much of the balance of March, April, May, we were busy closing up transactions that had been in process for a long time. It was very difficult to get new assets launched because we couldn't show buildings, particularly income-producing properties. There's some activity on land because you don't have to show land, so we've had some decent activity there. But clearly, there is an air bubble in the volume pipeline and investment sales caused by this shutdown that I think will manifest itself in some pretty low volume numbers in the third and fourth quarter of the year. Although I think, one of the things that I've said to people, and it's so difficult to say without sounding completely self-serving, is that if you are intending on selling a building within the next few years, you should sell it right now. Reason being, if you look at the past, and if people have said, Bob, what should I do? Should I sell? Should I hold on? Should I wait a couple of years, see what happens? And nobody has a crystal ball, so we really don't know. But the fact is, if you look at history for guidance, we see that during the S&L crisis, it took 4 years from the time the onset of the correction occurred until the time value bottomed out. And it was 10 years until you got back to the same pricing that you had at the previous peak. So we went from 88 to 92, and then to hit bottom, and then 88 to 98 to get back to the 88 level. For the Great Recession, it took 3 years for the values to bottom out. We peaked in 07, it bottomed at the end of 2010, and we didn't get back to the 07 values until 2014, 7 years later. So if you are a relatively short-term seller, history has shown that if you sell earlier in the disruption, you do better than if you wait a few years. And I think that's the calculus that folks are going through today. And I think it's still maybe a bit too early because we need a little bit more clarity. But I think within the next month or two, once we have some data points, get a better sense of what's happening in the market, I think that some sellers may opt to sell earlier in the process. And I also think one of the interesting things I've seen is, most of my clients are either high net worth individuals, family offices. I have some institutional clients, but most of my clients are individuals. I think that this pandemic has made people look at their own mortality a lot differently than they have. Certainly a much more tangible impact than after 9/11. And many of my clients have said to me, Bob, you know what? I have virtually all of my net worth tied up in New York City real estate. I must be out of my mind. I have to diversify a little bit. Maybe I should sell a few buildings and buy in other states. Or maybe I should sell some buildings and just put cash in the bank. Even if I get 0% return on it, at least I'll feel good sleeping at night. And I think so people are looking at the world very, very differently, and different things are taking priority. And so I think we may see some trading in the investment sales market for lifestyle reasons as opposed to economic reasons. And so I think that we could see that could be something that actually helps the volume of sales as we move further into this year and into next. And that selling, to the extent that properties come on the market in the third quarter, early fourth quarter, those won't close until next year. So I would expect that the volume in 2020 will probably rival the lows that we saw in 2009.
I see. But on a positive note, don't you think there's going to be a shortage of supply because of COVID. There's not much production. So it would
Herschel,
be-
I'm here to be positive. I'm the positive
okay,
guy.
I know. Okay. All right. Also, I want to ask Bob, how does COVID affect the future of different asset classes, such as hotel, office, residential, or retail?
Well, I think, Ralph made a very good point that it's very difficult to generalize, and even within each asset class, it's very difficult to generalize. I mean, clearly, the two asset classes that are probably most affected by what's going on is the hotel sector and the retail sector.
Mhm.
We need to see how many hotel rooms are going to be converted to something other than hotel over the next couple of years. And in the retail space, we need to see how many stores will reopen. That will be a bellwether for how those classes are going to perform. The multifamily sector, I think, is going to do great. I think this is a very short-term disruption. I think the way that the moratorium on evictions was conveyed to the marketplace basically had tenants feeling they didn't have to pay rent. So I think that's a relatively short-term dynamic, and I'm very optimistic about multifamily moving forward. In the office sector, I think it depends on how tenants are going to look at this experiment of working from home. I think we probably will have the densification trend will reverse and we'll go to more space per employee. That doesn't necessarily translate into a higher demand for office space. It really depends if companies feel like a certain percentage of their employees can effectively work from home or not. So we need to see what that balance is, the balance between more office space per employee versus how many people feel that they can have some of their workforce work from home. And that will determine whether the 100,000 square foot tenant that has a lease maturing takes 120,000 feet or 80,000 feet. And that's really the key metric for the office sector. Industrial is doing great. I think industrial will continue to do great. I've told several people that, industrial was already doing great when 11% of retail sales were done online. My in-laws are in their late 70s, never even went on the internet. They're ordering stuff online every day now.
Yes,
So I think that 11% probably goes to 35 or 40 or 45%.
Right.
And so that would be great for the industrial business. And so I think that sector will do well, but every sector is operating differently. There are different factors that will impact things, but clearly over the long term, I'm a big believer in New York, but I think we have quite a bit of wood to chop, as they say, before things get back to being what used to be the normal dynamics within the city.
Okay, thank you so much. And what are your views on how this time will affect the property taxes?
Well, theoretically, you would think that if value is going to go down, property taxes should go down. But we saw that during the Great Recession, 2007 to 2010, value dropped by 38% on average. I don't have any clients that saw their tax bill go down in any one year because of what's happened fiscally. There's depending on whose report you read, a $7 billion to $10 billion budget deficit expected in New York City this year. So unfortunately, I do not think real estate taxes are going down. And, I remember back in '84 when I started in this business, real estate taxes were about 4% of gross revenue. They're now routinely 30% and higher. Right. And that's really, really difficult for folks. And, if I don't see taxes coming down, unfortunately, just because the city needs the money so desperately, unfortunately, I don't think there's any relief on that front coming.
Okay, thank you so much. Ralph, I have a question. For some expert advice on loans, how are the banks dealing with deferral of payments? Will affect borrowers' credit or their ability to secure a mortgage in the future?
So I think that goes back to my comment before. When you say the word banks, it's a very general question and a statement. So I think when you say banks, you mean individual banks, and I think you mean lenders. Not to correct you, but what I'm trying to do is make sure that people understand. So a lot of the lenders understand that if there's an office building and the tenant's not paying rent, or if it's retail is not paying rent, or for some reason it's a residential building and the rents have gone down dramatically or a tremendous amount of not paying, they will work with the clients. We've seen that banks have been extremely understanding. They realize that no one did anything wrong here. This came at us without expecting it. No one expected this would happen. And I think they're being very understanding and accommodating and trying to really work with the clients to make sure that they can maintain their buildings, maintain the services, not have to put, extra pressure on themselves to make the mortgage payments. And they've given them many type of different deferrals from 3 months to 6 months, from interest, from amortization to principal. And I think that if a client does it correctly and is entitled to it, is not playing any games, it will not affect them long term. And someone said to me, asked me this question. I said, you understand, it's like getting the deferment is the easy part. It's coming out of it and making sure that your client, to the bank, I said, this is coming out of it correctly. So I think that's going to define who the borrower is and how well he's done and what he's done with his excess cash flow during these months that he did not make those payments.
Right.
Right. So I think ultimately, if someone does it correctly, the banks it will not be held against them at all because everyone understands the situation. And I think it's really an interesting dynamic. And then you have the CMBS world where it's extremely different because there are services and special services, and they have different requirements. They're not regulated institutions, but they have bondholders that still need to get paid their interest and all different classes. So I think they will react differently, but they're also working with clients. If you have an office building and there's a reserve, the servicer will release that reserve in order for you to make those payments and let you catch up later. I have found lenders to be very reasonable if you ask for reasonable requests. And I think they're doing the right thing. And I think ultimately they will all come out of this stronger. And just, to echo what Bob was saying or Myron was saying, we've all gone through cycles, but none of us have gone through this. This has been unprecedented in any other. This is not a financial crisis. The whole world shut down. All right. I mean, the only other times the world shut down was when there was a flood, with Noah and the flood, and other times in history. So we can't talk about 85 or 92 or 2001 or 2011. Nothing like this has ever happened. And I got to tell you, I really, really do believe New York City is a resilient place, and people will come back to live. They will come back to the restaurants. One of my colleagues was told me this morning, he was walking down 2nd Avenue last night, and it was nice to see a lot of the restaurants had their tables outside and people were happy to be out there. So I feel that, we're going to see a much quicker recovery. Of course, we don't understand what happens in October, and if we have a resurgence and all these things that happen, but no one really knows. And the reality of it is, I think we got to take month by month. And if you really look, it's interesting because I say this, when it happened, everyone said, let's see what the April collection looks like. Then we said, what is May? Then we say June. Now we're saying July. I can give you all the excuses both ways.
Yes, I agree.
People want to pay the rent.
Right. So what happens if this goes on for another 3 to 6 months? Banks foreseeing a wave of foreclosure litigation, you think? What is going to happen?
I think it's exactly the same thing. Going on for another 3 to 6 months. In what sector and what happens? What did you do with if you were in forbearance, if you were in deferral? What did you do with the cash flow that you had over the last 3 months? If you saved it and now you can say to the bank, here's my accounting. This is what I have left after 3 months or 6 months. I need another 3 months. I believe the banks will work with the clients. I think it's the same thing that has happened over the last 90 days or 100 days will continue to happen. But again, New York City's opening up. There are, thank God, no new cases over here. Whatever we want to complain, they did a good job shutting down the city, whether it's a week late or 2 weeks later. And we've really protected ourselves. There are really no new cases. And I can tell you from being in the city and having my office open and really doing it exactly the way the CDC has laid out the guidelines, people are coming back to work and telling me, when I worked 4 hours in the office I couldn't accomplish in 8 hours at home. So I'm not one of those believers that think that everyone's going to start working.
I agree. I agree with you 100%. I'm positive about office space, and I don't believe working at home is productive as being in the office, to be honest.
I knew one thing. I'm married 37 years, and my wife wanted to know when I'm going to be home for dinner. I knew I better get back to work.
Yeah, now we're home, and they say, what time you getting out? That's reverse, right?
Yeah, I think another point to tag on to that, I think looking at tourism is a very important thing. And when are people going to get back to flying and visiting the city? And tourism is not just a hospitality related thing. Tourism impacts retail, Broadway, cultural institutions. And we had 64 million people visit the city last year.
Right.
What is it going to be this year? And that's something we'll be watching very, very closely because of the economic stimulus that tourism provides for New York. So that's another important metric, I think, to keep an eye on as well. And the sooner we can get folks coming back to New York, the better it'll be for all of us.
Of course.
There's no question the hotel industry in New York is going to suffer longer than the multifamily, and the retail is going to suffer longer than the office. I think every sector is going to have its recovery time. It's all going to depend on tourism and everything else that we've seen be such a big part of New York City.
Right. Yeah, I mean, I've been watching the tourist business since 1982, and I saw that every year was going up, except 2020 is exceptional. So I think 2021 will be a good year also. Hopefully, when we get over all these problems, it will be a very strong year, and we'll have a lot of tourists coming to New York. Now, I want to ask you, Ralph, do you think the banks are going to be more conservative as we're going and less generous for mortgages?
Being that I have a couple of my friendly bankers on this phone, I want to tell them they've always been too conservative and always not been too generous.
Okay.
But on a serious note, I think this is definitely going to change. It has changed underwriting. It has changed vacancy factors. It has changed some of the attitudes of banks of, oh boy, someone takes cash out, but they're not willing to put it back in. So 100%, any bank that comes out of this and doesn't make some changes is just not smart. You need to learn from this, okay? But like anything else, it'll take a year, it'll take a two, the market will get bad, will get good again, collections will be strong, rentals will be strong, and then the banks will follow suit in an organized, thought out process.
Right. I'm going to ask a general.
Haven't the banks for the most part been relatively conservative though? I mean, I think from what we're seeing, the senior lenders are in great shape. It's the mezz lenders and fighting within the equity portion of the capital stack that we're seeing today, because folks who are trying to get a waterfall within the capital stack, those are the people who are really seem to be under the most stress, and the mezz lenders, not the senior lenders.
100%. The senior lenders have never lent without cash flow. They've always been conservative. They've always underwritten the loans if interest rates were 100 or 200 basis points higher. So I think the senior lenders are really safe, and that's why they're continuing to lend in this market. And even with their conservative approach before, they're doubling vacancy factors, they're taking reserves, they're doing everything prudent. It's really but I got to tell you, even in New York City, I talked to some of the pref lenders and the mezzanine lenders. The ones that kept it to 85% are still pretty good. It's the ones that really lent because of future rents, and then they got caught with the rent laws, and then those type of things. I think the difference between this time and last time is we don't have a credit crisis now. We've had a situation that the country got shut down and New York City got shut down. But lenders learned from last time, and you're 100% right, Bob. All the risk has been taken in the debt funds and in the mezzanine and other type of lenders.
Okay. I want to ask a general question from you all. How do you believe the market and climate of real estate in New York City in 2020 will compare with 2018 and 19, or even 2008 and 2009? I mean, anybody? I would say, Bob, maybe you could answer that question, if you remember.
There's so many different ways to compare them. I always look at the two V's. volume and value. Volume undoubtedly will be down. Value is to be determined. You know, the interesting dynamic is whenever a market shifts and when value shifts to the downside, when real value shifts down, value appears to be going up a little bit or holding, but volume drops significantly because people can't get their price, so they don't transact. So I think that 2020 is likely to see clearly a downward movement in the volume of sales, both from a number of properties sold and a dollar volume of sales. And value is to be determined. Again, the reduction in value through the first quarter was relatively minor, but we need to see more trading to get a sense of what the impact on value will be based on the COVID.
So would you say liquidity is much more than 2008 now?
Well, liquidity, I think there's been some interesting trends going on in the market. Clearly, we've seen a lot of capital from the multifamily sector in New York doing two things mainly. One, that capital that has historically been targeted towards multifamily in New York City is going to other asset classes within New York City. Those investors are looking at office, they're looking at retail, and they are also looking outside New York City. And I think everybody agrees that that your appreciation in New York is very likely to be higher than anywhere else in the country. But cash flow has historically been a little better outside New York, or a lot better outside New York than in New York. But today, the cap rates are almost identical in a lot of these other places. And so the perception is, hey, maybe this is a good time to buy New York. If I'm getting the same cap rate in Phoenix that I'm getting in New York City, I should be buying in New York. So there's a lot of questions out in the marketplace, and it's really fascinating to watch this flow of capital as investors are making decisions about where to go for cash flow, for appreciation, for tax purposes. It's very, very interesting today.
Yeah, but Bob, I mean, you talk about 2008 and 2020 and 2020. I mean, we have not had any Bear Stearns, any Lehmans, any bailouts. This is not a financial crisis. The government with stimulus has pumped a lot of money in. It's really helped a lot of people. You know, people like to say that no one wants to go back to work. I had a furloughed employee. They actually called me back and said, I'd like to come back to work, even if I don't get paid a lot. I just want to get back to work. I have a very different view. This is not a financial crisis. Everyone's trying to compare it. We have not had any failure. The banks are extremely healthy. They have good reserves. The regulators have given them a little bit of pass on forbearance now. And it's really just a medical, it's a critical medical situation that is turning into a financial in certain sectors. When
I agree with you. You're clearly number one in a lot of things and number one in optimism. But I'll tell you, for the guy who owns a hotel, this is a financial crisis. For the retail tenant that has a restaurant and doesn't know when he's going to be able to open up again, or if people will come back to his restaurant, or he was living month to month and now, you know, can't make it anymore, is not going to be able to reopen. This is a financial crisis for that guy.
True. So that's individuals. Those are individuals, unfortunately. I can tell you one, when I come home at night now and I trip over all those Amazon boxes, I know where retail is going. All right. Retail is, you know, I drove my car over the other day, and all of a sudden I rode over a carton, and there was some products in there. Like, my wife went shopping for groceries, you know, on the internet. So the world has changed. When I mean a financial crisis, I'm talking about a Lehman, a Bear Stearns.
It's not systemic. I agree with you, Ralph. It's not systemic, but there are. You think about the way businesses are going to come back. I think incrementalism is going to be something that is going to have an impact on our underlying fundamentals. And I think you look at a company, I won't mention the name, but a company had 3,000 employees. They laid off 2,800 of them. They're not going to go back when phase 2 starts or phase 3 starts. They're not going to go hire those 2,800 people. They'll hire a few hundred and see how business comes back and that kind of thing. So I agree with you. This is not a systemic financial crisis, but it is having a profound impact on a lot of folks. And when you have this type of disruption with all the people that are out of work, disposable income spending goes down, and there are a number of impacts. And I hope that, you know, a therapeutic or a vaccine is found soon so that people feel like they can go back to living their normal life. But I don't think this is flipping a light switch on and it comes back. And I'm not being negative. I'm just trying to be realistic about it.
I think in certain sectors, you're 100% right. Hotels will take a long time for people to start traveling again. There's no question about it. And I think the small retail tenants, people still want to go, you know, out and shop on the avenues, and those small tenants will survive if the landlord works with them. I spoke to a landlord today, and he actually told me, he said, I have spoken to every one of my retail tenants. I understand their financial situation. I've given them some relief. I've given some forgiveness. My residential tenants, I've actually have over 90% collection because I've worked with them. And I think he's just a good landlord that understands the situation. And he said I was only able to do it because, you know, the banks worked with me and it gave me some type of relief so I could pass it on to the tenants. Now, if we can get the city to reduce our real estate taxes, well, you know.
Okay, my last question. Do you see any opportunity for private sector in Manhattan right now?
I think this is an incredible time of opportunity. And I think you're going to see a lot of very interesting purchases being made, interesting moves by companies. There are funds being raised now to take advantage of the opportunities. So whenever you have something like this, I think it always creates opportunity, and it's actually a kind of an exciting time. I'm looking forward to see what happens. It's always interesting when part of the market's going one way, part's going another way, and you have people with different philosophies. So I think it's a great time of opportunity in the city.
Whenever there's disallocations, there's opportunities. So I think what Bob's saying is 100% correct. And I think some of the families that didn't buy and sold are coming back and slowly, you know, trying to see if there's something that they can buy. And I think even some of the larger long-term holders of real estate look at this as an opportunity to buy because you can get a real return on a multi-family in New York City today.
All right. I want to thank you all for being here tonight. I'm sure our audience enjoyed your answers. If you have anything else to say, please feel free before we end the night. And I want to thank all the viewers for coming to the Zoom and be with us. I appreciate it. Bob, Myron, Ralph, thank you again. And hope to see you in person soon.
Thanks a lot, Herschel. And to everybody out there, stay safe and healthy, and have a great night.
Have a great night, gentlemen. Thank you again.
Good night, everyone.
Take care.